I'm Ryan LaFond from Algert Global. We're a quantitative investment firm based in San Francisco. We've been working on ESG-related issues for years, as we've always found these to be both important features for both risk and return. Increasingly, they're more important to our clients. But there's no quick or fix or simple answer to many of these issues. The data is messy, it's inconsistent, the measurement is full of holes, which makes this both an interesting and really challenging area. Today, we've labeled this talk and panel session, Thoughts and Ideas from Practice. I guess maybe a better title might be, what can you learn from our collective experience thus far? It's great to see these issues getting more attention. For many of us, it's been a really long haul, and it's nice to see them finally come to center stage. In the US, we're still behind the rest of the world, but hopefully we're catching up quite quickly. And for many of you out there that might still be skeptical, these issues are real. We're trying to make change, and the dollars behind these changes are massive. This is all very good progress, but there are still some big challenges. And in a challenge perspective, it all starts with data. If you don't measure it, how can you change it? And when it comes to climate in particular, there's a broad diversity in data out there, but what we struggle with are issues like standardization. We struggle with things that we think of as like the selection biases behind the data. Basically, most of the data we have is for firms that are either digging stuff out of the ground or burning things that they dug out of the ground. And lots of times what we find is just because you can't find data doesn't mean that this isn't an issue. The other challenge we really have with a lot of the data is that there's more data on bad things than there is on good things. And one of the challenges with that is a lack of bad doesn't necessarily mean that things are all good. We hope to cover a lot in the Q&A, so we'll stop there for now and turn it over to Don to introduce himself and give some opening comments.
Thanks, Ryan. My name's Don Hamson. I'm the Managing Director of Plato Investment Management. We also are a quantitative or systematic investor. I also dabbled in my early days in academia. I was a lecturer at the University of Queensland and also visited the University of Michigan as a visiting professor. I've been investing for over 30 years and looking at sustainability issues and running sustainability funds for more than 20 years. And I agree with all the comments. There's a lot of data out there. There's a lot of differences in the data. It's quite hard, but that's our challenge. And you have to start somewhere. So, but it's certainly a very important issue for many clients. We've been running a low carbon portfolio for a university foundation for now more than 5 years. And there are certainly a lot of investors out there that want to do the right thing for the environment. They want to do the right thing in all areas of sustainability. But there's many ways you can measure it. But I think it's important also that you come at it from an investment point of view. And we always try and balance up our fiduciary duties, which is to try and maximize returns given levels of risk for our clients, as well as optimize things like building a low carbon portfolio. So we're trying to balance out multiple objectives for clients, but we think it's very important that clients should be focused on their returns as well. And we try and build portfolios from that perspective. That's all I'm going to say at the moment. I'll hand back to Ryan.
Great. Lukasz, all right, Simon, you want to introduce yourself?
Yeah, hi, Ryan. Thanks. Simon O'Connor. I run an organisation called the Responsible Investment Association in Australasia. It's a peak body for responsible investors across the region I operate in, Australia and New Zealand. And yeah, I think this is a timely discussion. And Ryan, thanks for those opening remarks. We are at a stage, our organisation's been around for 20 years, but what we're seeing right now is this state of professionalising what we do and what we talk about and building it and hardwiring it into laws and regulations and accounting standards and industry standards around the world. And it is a tricky process because much of what we're trying to value isn't monetised. But I think there's great opportunity for investors who do that well. And so there's this huge regulatory momentum behind this right now. And so it's really rapidly becoming a compliance issue more than this is a nice to have issue for investors globally, I would say. So it's fascinating for me. I also sit across an organisation called the Global Sustainable Investment Alliance, so peak bodies around the world. And really many of the trends driving this are consistent in different markets. Regulators and policymakers, our consumers and customers, and of course, the understanding from many of you in this room, the quant investors, that ESG factors can help to provide greater alpha or support greater returns, or at least avoid downside risk. And so there's these sort of three underlying drivers that I think are really interesting to watch how they're playing out in different markets quite differently. But fundamentally, yeah, this is a state of transition for our market and a state of professionalization where we're rapidly seeing this whole topic being hardwired into our codes of practice, our regulatory environment, our standards, and even our accounting standards. So thanks, Ryan.
Great. Who's it? Do you want to introduce yourself?
Lukasz Pomorski, AQR Capital. I'm the head of ESG research at AQR. What it means is that in some shape or form, any research project that has an ESG angle to it, be it an alpha signal or a new product design or a white paper, for example, crosses my desk. I'm responsible for building the agenda that we have around ESG and oversee its execution. AQR is a systematic manager. We invest in pretty much all liquid asset classes around the world. So having done quite a bit in terms of ESG in the most obvious places, public equities, for example, we're also very interested in potentially thinking about ESG use cases beyond, let's say, the corporate asset classes, both for the reasons that are already mentioned, trying to create a better strategy. And in some shape or form, around 90% of what we do, so 90% out of roughly $140 billion under management, has some element of ESG incorporated in the way that we run the strategy. In addition to this, or rather on top of that, around 20% of our AUM today represents strategies that are explicitly ESG focused. These strategies would be Article 8 labeled, if you think about the European SFDR regulation, or for broader audiences, strategies where we have multiple objectives. Some of them are purely returns or risk return driven. Some of them are driven by considerations such as climate, for example. I also try to be an active voice in the investment community when it comes to ESG. For example, I sit on the hedge fund advisory committee at the UNPRI. I also teach a course on ESG investing at Yale University. So I thank you for the invitation to join the panel, and I'm looking forward to sharing my views with you. Thank you.
Great. Andrew, you want to introduce yourself?
Thank you, Ryan. Hello, everybody. My name's Andrew Porter. I'm from Melbourne in Australia. I'm the CFO for Australian Foundation Investment Company and some other listed funds management businesses. We've been in operation as a company for nearly 100 years. And Australia has a compulsory superannuation system, which means that people have to save for their retirement if they are in work. What that means is we have a broad range of investors. Currently, we've got over 200,000 in retail investors across the group, for whom AFIC is a cornerstone of their shareholding. As you can imagine, they come from a wide range of backgrounds and of views, and we have to be cautious in terms of how we approach a lot of issues that affect their well-being and in terms of their finances. As has been said, we have a fiduciary duty to maximize returns, but we've got to do that not just for the short term, but particularly for the medium term and the long term. And I would say for close to that 100 years, ESG has been at the back of our thinking for a lot of these investments, particularly the G and the S. So how are boards that we invest in run? What are they comprised of? Do we want to put our money with those people? Do we trust them? Are they running the companies as we would expect them to be run? They are, after all, our companies. We own them. And increasingly now, we're seeing more focus on the E part of the ESG. And that is, of course, coming into our calculations as we work out what's going to be in the medium and the long-term interests of our investors. I'm also the former president and chair of the G100, which is the national CFO organization down here in Australia. I remain on the board, and I can tell you this is an issue that is at the forefront of many of my colleagues' minds. Thanks, Ryan.
Great. And finally, Gavin.
Thanks, Ryan. Hello to everyone. So I'm Gavin Smith. I lead the equity research team at QMA. So QMA, we're the quantitative manager within PGIM, which is Prudential's investment management business. So my team with research, we look at research into factors, portfolio construction, but of course also ESG, which is what we're talking about today. And so when it comes to ESG research, the things that we're doing as a quant managers, we're trying to rethink how you evaluate ESG attractiveness, trying to deal with this problem of data scarcity. Ryan touched on that a little bit in his introductory comments. We're trying to think through how to best integrate these ESG insights into portfolios. And effectively trying to build more of an ESG capability that allows us to try and deliver a variety of different ESG solutions to investors. And that's a really important point here when you're approaching ESG. Investors vary so much with their preferences around ESG. So we're trying to do things like ESG index alternatives, thematic solutions, ESG overlays. And I'll highlight just some of this to give you a sense of the variety of research that can take place within the ESG umbrella. It's really a fascinating area, but it's in its early stages, formative stages. And I know with many researchers in the audience, I encourage more people to get into this space to do research into ESG because it's that real chance to shape the direction of ESG moving forward. Thanks, Brian.
Great. So I think we got a broad diversity in terms of the panel, a quite broad kind of subset in terms of some of our opening topics. And so what we wanted to do now is a little bit turn into a little bit more structured discussion of some specific issues. And really to start off, one of the things that comes up kind of all the time in this space is kind of, you saw in some of the opening remarks, is how should we think about ESG and climate? Really from the investor's perspective, are they alpha factors? Are they risk factors? Are they non-kind of financial preferences? And maybe to start, I'll turn it over to Don and Lukasz to start off. And if Don, maybe you want to go first, and Lukasz, if you want to go second, that'd be great.
Yeah. Well, I actually think climate factors in ESG are actually all three. I think they can be alpha factors. They are risk factors, I believe, but they're also from a client's perspective. And I know one of our clients, it's a preference that they have, a non-financial preference that they want to do good for the environment. But it would be nice to think that they can be priced as well. So, we've actually done some research. We actually do use ESG factors as both risk factors and alpha factors. We started it from a risk perspective, and we actually built our own statistical risk model, and we use ESG signals data to help explain the risk of individual stocks. And the risk model does find that statistically some of these ESG factors do help explain risk, and stocks with poorer ESG fundamentals are actually high risk stocks. And you think about it, if you've got high exposure to carbon or emissions and they're eventually priced, it's probably going to come out as risk. But it also may actually come out as an alpha factor. Again, if you have high exposure to carbon and that carbon is priced, you might think that might influence future returns for stock. We've done some research around the globe, actually, just this year, looking at explaining returns within sectors, so trying to control for different sectors, etc. And we've found that in Europe, where carbon has been priced for more than 10 years, stocks that have low exposure to carbon, or relatively low given they're in quite narrow sectors, have actually outperformed stocks that have high carbon intensity or emissions. So it seems in a country or in a region that has priced carbon, and really it's only Europe that's done that, high exposure to carbon seems to have been an alpha factor for the last 10 odd years. It's a pretty consistent trend. But we didn't find the same results in the US or in our own region here in Australia and Australasia, because there hasn't been a strong price for carbon, or any price really. So we think they can be all three.
And I would agree. They can be, and they probably are all three. And at the cost of being boring and repeating what Don said, I would agree with that. I can maybe add a little bit of color. I view ESG when it comes to risk and return more as a source of information, source of data. And I would actually not go as far as saying that anything that smells like ESG can be helpful. I think, as Don said, we need to do the homework, we need to do the research and actually identify those nuggets of data that actually may be more material for a given company, for a given industry, given country, and then build it accordingly into a risk model or potentially into an investment view. I will say that if you think about ESG more broadly, the governance pillar is perhaps the most mined, for a variety of reasons. There's at least a couple of decades of academic studies, for example, that look at different facets of governance. One of the best known papers in this space is actually the strand of papers on earnings quality as just one metric of how well governed, how conservative versus aggressive a company may be. And again, going back multiple decades in terms of evidence. Climate, so the focus on our call today, is much newer. It's much more difficult to get quality data going back in time. But even in climate, I think it's a very plausible source of insights for both risk modeling and alpha modeling. You may need to fight through the challenges that I'm sure we'll talk about on this panel, but I do believe that there's many potentially actionable insights. I will also spend a couple of minutes maybe talking about the impact aspect of ESG, or could be purely ethical, could be sort of non-monetary preference, if you will, for building a portfolio that reflects your views, that potentially can be positioned to do well. This is something that is very important to many allocators, and I think that the onus is actually on portfolio managers to be able to articulate those preferences, build portfolios that are aligned with views of our clients, including those that are not purely financial. The last thing that I'll say is that to some extent, how much you can actually leverage ESG, whether it's for risk or return or impact, may depend on the specific strategy you're looking at. And I'll just highlight maybe one item here that is important, that is the length of the investment horizon that the investor may have. If you're running a very high frequency strategy that may rebalance multiple times within a day, or maybe even on a day-to-day basis, you want to close your books, so to speak. You want to be net zero at the end of a day in terms of your risk exposures. It may be very difficult to find meaningful ways to incorporate ESG into that strategy. At the other end of a spectrum, if your strategy's holding period is multiple years, I would strongly argue that there's a lot more potential use cases for ESG. And I would go as far as saying that the portfolio manager would probably be remiss if they didn't at least consider that ESG may have a meaningful impact on the risk profile of a strategy, and potentially on what you may achieve in terms of impact through voting or engagement with the portfolio companies.
Thank you. So I think, part of the last little bit I heard from you there, it's a nice lead into the next kind of question. I think I heard we should be skeptical of high frequency ESG strategies, maybe. With that and kind of some of this, I think maybe this is a question really for Simon. I think recently we've heard more clients and regulators about kind of this notion about the integrity in labels when it comes to ESG and climate. I guess maybe, given the seat that you sit on, can you discuss a little bit, what does this mean? Are the labels important? And do we really see like regulators kind of doing anything about the labels?
Yeah, absolutely. And, in any fast growing market where there's massive consumer interest, there's going to be people making claims and marketing talk about what they are doing and not doing. And some of those claims may be overstated or stretching what they're doing compared to others. And we're now in a place globally where, a recent report we've been involved in with the Global Sustainable Investment Alliance found that around 36% of all professionally managed assets now are under sustainable investment strategies. So that's about 35 trillion, and that's grown substantially and continues to grow substantially. And so what we've seen is the regulators starting to move into this space and say, well, we're going to confirm that the claims being made can be substantiated and evidenced. And that's really come down from IOSCO as the peak securities regulator globally, who have a work stream on this, and that's feeding down through to national regulators. So recently the US SEC's come out saying they're going to start looking at ESG statements and claims to make sure they're substantiated. Here in Australia, ASIC is running a similar review of funds to make sure people aren't misstating, otherwise known as greenwashing, around products. Certainly in New Zealand recently, we've seen the Financial Markets Authority come out with guidance around this. And probably, the clearest example of this really comes to Europe, where they've very prescriptively legislated what a sustainable investment must do or not do and how it must substantiate claims. So as Lukasz said earlier, the definition of Article 9 funds, Article 6 funds, Article 8 funds, and really very prescriptively articulated what those must constitute, to the extent of now having a taxonomy in Europe that defines what's a sustainable or green activity versus a non-sustainable activity. And I think we'll see very rapidly that concept of a consistent taxonomy will spread around the world very quickly. And we now have markets all over the world developing these kinds of taxonomies. So when you make a claim around this, you'll be able to say instantly, right, my portfolio contains 67% of the activities of the assets of the companies in the portfolio are green activities, versus the neighbouring fund managers fund, which has 73.5% of the activities are green activities. So it's aiming for precision in a field where perhaps that's stretching what precision can bring. And also the risk here is, but I think it's very useful from a consumer perspective, very useful for standardization. I think the risk here also is that we miss the opportunities to create change and impact and outcomes through holding those brown assets or not green assets. And a lot of what responsible investors, sustainable investors do is actually work with those companies that aren't yet green or sustainable, and transition them in that direction. And so that's probably one more for the quant managers. Perhaps even that's where the alpha lies. So the distraction here might be that a consumer will obviously head to the funds with the greatest proportion of sustainable or green assets. And yet those fund managers creating the greatest change towards sustainable outcomes may actually have a high proportion of non-green assets. So I'll leave that to the quants to sort of determine where the returns factor comes in. But yeah, there's certainly a global shift very strongly towards avoiding greenwashing and ensuring that fund managers are substantiating and evidencing their claims.
Thank you. I mean, given the, I think, large accounting academic audience here, much of kind of what Simon was talking about in terms of greenwashing and substantiating the claims should appeal to a lot of folks doing research or looking to do research in this area. Maybe turning away from that a little bit, when we've got a panel of folks that run a variety of kind of strategies and money. And so I want to probe into this label a little bit more and kind of ask the question is this really, when we talk about climate, we talk about ESG, is it really a change in your investment process, or is it just a label? And then the second point is, like, from your experience, is there a way to really tell the difference between somebody who's changed what they're doing versus someone who's just kind of slapped the label on? And maybe we'll start off with Gavin on this and then go to Lukasz.
Thanks, Ryan. So for me, when I'm thinking of the integration of ESG into investment processes, it's actually more just a natural evolution. And I say that, I'll defend that by thinking of what ESG is really about. ESG is trying to capture the idea of the strength or the quality of relationships between a company and its stakeholders, relationship with customers, suppliers, employees, the community, the environment. And by doing that, it's trying to get a better sense of the drivers of profitability for a company, how that profitability can be maintained in the future. And when you're thinking of it like that, that's really the crux of what we're trying to do, really, as quant, as factor investors, when we think of, say, the quality of a company. And the great thing then about using these ESG issues to think of quality then is that we can capture these drivers of profitability in a much more direct manner, as opposed to what we've been doing previously, using these different indirect proxies from the financial statement. So you might be saying, sounds great, but why now? Why are you starting to explore ESG as that driver of quality? It really comes down to an increased availability of data. Still not great, but there's more data around, making this direction of research much more viable. So for me, it's been this natural evolution. But yes, I will acknowledge there has been some new capabilities introduced into the mix. Been mentioned already, things like low carbon portfolios, these decarbonisation strategies. Think of Paris-aligned portfolios. This is something new for managers. You could think of it as being a bit more of a change to the investment process. But I see this as being more of a part of the natural innovation cycle, if you like, that comes about where new product comes about to changing investor demands. But what you see then when you think of these products, it's really not a significant change to what we've done in the past. And again, I'll say this by giving you an example. Think of the introduction of innovation, the introduction of equity income strategies. Here, we're trying to build portfolios balancing equity, return, risk, and income. But in these new strategies, we're doing similar things. We're changing the objective, but we're looking at return, risk, and carbon now. So it's a situation now with some of these new products, these new capabilities, we're leveraging old skill to deliver new solutions. But to come back to the last part of your question, Ryan, how can people try and better discern, separate the reality from marketing, there's a few simple things to be looking at here. Number one, the investment philosophy. Is ESG embedded into the philosophy? Is it a core part of beliefs about how markets operate? Second, where do people get their ESG insights from? Are they generating these themselves, or are they just going off the shelf and purchasing data from MSCI and Sustainalytics? That doesn't demonstrate a real commitment if you're going that path. It's about looking at the resources you build up inside your firm. ESG is quite nuanced. You do need a distinct expertise. Do you have these people in place? And the last point that I'd say that helps you discern reality from marketing is the firm taking a more holistic approach to ESG? Integrating is only part of the process. Are you engaging in as well? By doing that, you've got this holistic approach that demonstrates a more serious commitment, and typically an indication of where firms are going beyond just marketing.
I'll try to add to this. I'll try not to repeat too much, but I'll start with again agreeing with Gavin. The obvious area to incorporate ESG is to enrich your investment view, and the formal term is integrate ESG in your process. And I agree. ESG insights are often very useful in terms of informing your view about the quality of the underlying company. We actually have multiple sort of examples of how we use ESG insights to improve our view of a sentiment around the company, whether from stakeholders within the company or sort of broader society, for example. We also have, even in valuation, we have elements where we look at the empire building type activities where, again, speak to at least some component of governance. So all of that is certainly part of our process. I think many other managers will be very similar. And I actually will posit that that's not quite enough, in my view, to actually label a strategy as an ESG focused strategy. There's a few reasons for that. Maybe the most direct one is that take AQR. So we have strategies in stock selection, for example, that we have maybe 15%, so 15% of what we do in terms of the model weight, in terms of the signals we utilize, are actually explicitly ESG driven, looking at transparency of the underlying company, any number of other dimensions. Now that's a meaningful minority, but it's still a minority. So you could very easily have a situation where you have a stock, for example, that you hate for all your ESG reasons. All your signals are very negative on that particular issue or that stock, but maybe that stock is cheap enough and improving enough and has other aspects of quality that are strong enough that you actually will end up overweighting, going long that stock, for example, in the portfolio, going against, kind of outvoting the ESG signals. So I think for a strategy, but at least for AQR, we try to be somewhat conservative on this point. For us to label something as ESG oriented, we actually require a little bit more than this. Formally speaking, I would say that we need to blend other objectives, not just the objective of generating the highest possible information ratio, for example, versus the benchmark, highest possible Sharpe ratio for a long-short strategy, but we also need to have some kind of secondary objectives that are explicitly ESG driven. And it could be, in the context of climate, it could be something as simple as, for example, reduce your emissions footprint versus the benchmark, which is kind of table stakes in this space nowadays, but it's a great example of what else you need to do to be able to label a strategy ESG oriented. And I think Simon mentioned that there is multiple issues with labels, and I completely agree with him. I will just echo the point that he made about the clash between being ESG labeled and the potential of doing impact. For example, if you build a low carbon strategy that by definition will not hold many of the companies with high emissions, well, at least in a long only context, you will rob yourself out of the ability to vote and to engage with the companies that simply are not in your portfolio. So you may engage with the companies that already do all the things that you care about. You don't have much ammunition to engage with those issuers that are doing most of the emitting, for example. So if you wanted to do impact, you may need to seek a strategy that might not qualify for a quote-unquote ESG label in terms of its holdings. So I do agree that this is a very nuanced area. I still believe that ESG labels are important, if only for, well, certainly for regulation, but also for the clarity of discourse with our stakeholders, clients, for example.
Thank you. So I'm going to switch gears again here a little bit. And, does the importance of ESG and climate vary across kind of different client types? And here I'm thinking primary, institutional, retail, but maybe retirees, millennials. maybe we'll kick off with Don, but maybe Andrew and Simon can also add to this debate here a little bit.
Okay, thanks, Ryan. Well, we have a diverse client base. Actually, we run money for retirees, for university foundations, and for the large superannuation industry or pension industry here in Australia. And historically, that we've seen the greatest, I suppose, drive for ESG portfolios from university foundations. I think I mentioned it. We've been running a low carbon portfolio for more than 5 years for a university foundation. We've got another university foundation which is looking to set targets in this area over the next 5 years. And certainly the movement of the Paris Agreement has moved things along. But we've also seen a lot of the pension funds, or we call them superannuation funds here in Australia, are also adopting targets in this area, and these tend to be the pension funds in Australia tend to be sector based, and it's interesting. You probably see the most focus on these areas from groups such as academics or say healthcare industries, where I think they have more sort of interest in these areas and doing good for the environment and socially good than other sectors. But even it's interesting, we've run some money for a fairly dirty industry pension group, and they are adopting these same sort of criteria. So that's where we see the main interest. And typically now we don't have an ESG labeled product in the market, so we're not actually targeting these sorts of individual retail investors. But it's interesting that in the last, just this year actually, I have got more inquiries from the retail market than I've ever had before. In fact, I might put it the other way around. We are getting inquiries from retail investors around ESG where we've never had those inquiries before. So that's starting to change. But I might leave it there because I think we may have another question looking at how things are changing. But yeah, we've seen the most interest, particularly from university foundations, where I think student bodies and academics do think about other issues, and it's not just totally on return.
I'll just follow on from what Don was saying, and that is interesting, and it accords with my thinking that a lot of the focus on ESG has come from the institutional funds, and particularly charities, universities, etc., which is what one might expect. With our shareholders, as I said, it's 200,000 retail shareholders, predominantly self-funded retirees. As you would expect, there's a huge disparity of views. And what does ESG mean? How important is it to them? We have some shareholders who say you shouldn't have anything to do with anybody who invests in coal, or probably even transports coal, for instance. And we have other shareholders who will say, why are we selling our energy assets cheaply to the Chinese? We need to be keeping hold of those here in Australia. And I'll echo something both Simon and Lukasz were saying, and there's a middle ground of people who are saying, if you want to affect change, you've got to own these companies and engage with them. Dropping them like a proverbial hot potato is not going to make any difference to the climate environment at all. And I'll come back to something that Gavin said, quality. Pretty much all our retirees want us to invest in quality companies. We use the ESG matrix to look at quality, but it's that definition of what a quality company is that can vary with retirees. As I said, some of us inherited shares and have had shares in our company for 70 or 80 years. That's the sort of time frame they want us to be looking after their investments. And ESG, it's very difficult to measure, but my goodness, you know when a company gets it wrong. Just, I don't know if you've seen what's happened with when Rio blew up some gorges out here in Australia, which had some sacred Aboriginal paintings in. The value has, was, I wouldn't say destroyed, but certainly suffered badly on that because it was shown as badly managed. Now, we didn't want to sell out of those assets because Rio have got some very good assets. We own those company, we engage with it. Management went because management would have been mismanaging those assets and destroying value. And that fundamentally is going back to what Gavin said. It's about the quality of a company, and all shareholders, in our experience, want quality. They just differ in what that quality should be. Thanks.
And maybe just to add finally, Ryan, if I can, the consumer research we run here and that we look at globally shows that fundamentally most clients expect as a minimum that their investments being managed on their behalf do no harm. It's very rare that you would find a consumer, if you ask them, that really want to invest in child labour, tobacco, really nasty weapons, etc. And so I think there's been just this implicit expectation that their money is being managed by us on their behalf without doing harm. That's pretty universal and increasingly so, I think. But this expectation of higher standards and higher sustainability and doing good through portfolios is certainly shifting dramatically. And I'd say there's certainly that institutional story we heard about there. I think the retail side of the market is taking off in many markets where there is a realization that you can choose products, investment solutions that actually deliver pretty damn good returns and do some good, invest in some impactful outcomes. I think that's probably evidenced by the fact that we're seeing, certainly in Australia, the financial advice part of the market through investment platforms and wraps are all very rapidly putting lots of products and ESG menus and sustainability options up there and are seeing really strong flows through those platforms into those funds. So we're seeing some really strong flows in that area. And also I think, and from that question that you mentioned around the sort of demographics, I think certainly there is a millennial story here, but there's also the other end of the age spectrum story here when we look at most data, and that is the sort of retirees thinking of their legacy, their grandchildren, and those at the early stages. But I think that sort of millennial side is probably also evidenced by most of that sort of investment, on internet-based robo-platforms, robo-advice platforms, online share trading platforms. Nearly all of them having their marketing or having what they're offering to clients some element of sustainability, ethical, ESG type of elements. I think that's really appealing to that younger platform too. So I think although it's differing across client types, I think there's an overall surge in this direction that's pretty universal.
So, I think one of the things that's interesting, and to give us a little bit, you talk about the surge there, Simon, and maybe can we try to get a sense for how much things have really changed in, say, like the last 12 months versus, say, the prior 10 years? And maybe Don and Gavin can kick off here.
Yeah, Ryan. I mentioned before in the retail space, we've actually seen people ask us the question in the last 12 months where, to be honest, we've really seen not that much interest, where people were much more focused on, I think, just returns and getting a good return. But in the last 12 months, there seems to be a sea change. And look, I think part of it is people are now, probably in Australia and the US, fed up with their politicians not doing anything and realizing that they may have to change. I think in Australia, we've a lot of there are probably a lot of climate skeptics, particularly in our politicians. But I think some of the things we've seen in the last 12 to 18 months, we had some huge fires and heat waves here in about 18 months ago, and I think a lot of that made a lot of people think, gee, we really have, this climate change is really affecting the country. You've got heat waves in the US at the moment as well, and I think some of these, people are actually realizing, even the skeptics are realizing that climate change is here, because we're setting new records for highs and lows, etc. And so we have seen a huge increase in the interest of people wanting low carbon portfolios. So we've had one client for 5 years, but we are developing some products right now that are global low carbon products, and we have not seen as much interest in, we've seen huge amount of interest from institutional clients in this sort of area. So there is a groundswell, and it is increasing. And I think probably the change in the president in the US has also changed things as well. So there is a groundswell, I think, in the last, particularly 12 to 18 months, of people, particularly on the climate side, wanting to actually do something for the environment, because I think they've. So even those skeptics are realizing that things are changing.
Thanks, Don. Yeah, so much has changed over the last 12 months and compared to the last decade, but there's still so much more that needs to be done in this space. I commented earlier, it's still in its early formative stages. So what you've seen, not just over the last 12 months, but over the last decade, you've seen just this explosion in all these different standards and frameworks for ESG. Think of SASB, TCFD, GRI, CDSB, SDG. It's an alphabet soup. It's so confusing from an investor perspective. I'm sure it is for companies. What I'd love to see is just more consolidation on that front. And you're seeing that at least with SASB and IRC. You're seeing some consolidation there. That's really important in this space. You're seeing just this explosion really over the last 12 months of product proliferation in the ESG space. It's just increased rapidly. And that goes back to this focus over the last 12 months on labeling, the movement around SFDR, these demands to get that Article 8, Article 9 classification. This is a great development, but I just want to see that really expand globally, because that's what you're seeing now with ESG. This is global. And as Don said, it's really global now because the US is getting on board with the change in administration. So a lot of these things around different ESG frameworks, standards, labeling needs to be global. That's so important as we move forward. But when you're thinking of investor interest, for me, this has changed a lot over the last 12 months. Much of the past decade, if there was interest, was much on that E component, carbon emissions. Because of things like initially the trade wars and then the COVID shock, a lot more interest on the S component and actually ESG in entirety. Because people are focusing on how companies are managing their supply chains, how they're treating their employees. All of ESG is now much more important to many people. But what we've also seen really over the last 12, 24 months is, well, from what I've encountered, is also a big rethink about how we approach trying to quantify ESG. This has been notable. And this is really relevant just to my seat in research. We've typically been very backwards looking with ESG, but we've now tried to embrace much more forward-looking metrics. Companies are starting to promote and release more of these targets of what they plan to do in the future. A great development. More needs to be done, but these are increasingly valuable. You've seen a change as well in terms of how we try and quantify ESG, rather than just looking at these intensity measures. And what I mean here is if you look at carbon emissions divided by sales, rather than just looking at that, trying to convert this into the real impact that's being had on the environment and society, or cost there. And you're seeing some very innovative modeling taking place. But also just as part of this, how you quantify ESG, you're seeing people embracing much more alternative data, utilizing NLP, utilizing machine learning to go beyond what companies are disclosing themselves. So this is encouraging, helping you fill in the gaps and get some richer insights. But the last thing just to touch on here is you're seeing ESG now expand across all asset classes. We've been very equity centric, I think, so far. We're all really equity managers. But you're seeing interest in ESG, not just in equities, but in fixed income and real estate. But you're seeing what I've noticed really over the last 12 months is ESG and really considerations around climate change move into strategic asset allocation decisions, move into that space, incorporating that into capital market assumptions, for instance. That's a huge development, and there's a lot of work to be done in that space too. I'll leave that there. Thanks, Ryan.
Great, thanks. So let's turn to measurement, and really specifically measurement about climate. So how can we measure climate risk or climate opportunity or even climate impact? We've had a couple people mention carbon, but maybe Lukasz and Simon, you can expand upon that. We'll let Lukasz go first here, maybe.
Sure. I'll try to at least make a dent in the problem, because it is worth probably a couple of hours worth of conversation. I think there's plenty of issues and opportunities here, and it's a really interesting challenge for a researcher. I will say that we are probably the beneficiaries of a huge increase in the number of potential data sets or tools that we can bring to bear on the problem. Some of the most traditional items that Ryan, that you mentioned, for example, that carbon emissions or greenhouse gas emissions of a portfolio company. This is something that is, as I mentioned before, sort of table stakes in this space. It still is really important, and I will say that even though we could quibble with the quality of the data or how stale the data is and so on, it's a really nice common language that you have between managers and clients. It's not a perfect measure by any means, but at least it's a measurement that we all can attempt to compare portfolios. It won't be a perfect comparison, but at least we'll speak the same language. And more recently, you have a lot more granular raw data, anything from, does the company have fossil fuel reserves? Does the company have any green technology? You can look at green patents, for example, or the quality of those patents. You can look at measures of physical exposure to climate change risks, meaning that companies that maybe are located or have property that is located in places geographically where they are more exposed to elements, to extreme weather events, to sea level rises, and so on. You also have a number of products from third-party providers where they will build some sort of weighted function of all these ingredients to give you a single number that is meant to capture everything there is to know about a given company's exposure to climate type risks. And I think the number one issue that we have here is actually understanding what it is we're talking about and understanding what the data actually means. And one of the roles that I see for asset managers, as people who actually do that research, is to be to serve an educational service and basically inform your clients or investment community more broadly about some of the insights that you can get using this data, some of the maybe nuances in how you might apply this in a portfolio, and so on. We also see a lot of potential opportunities in terms of building tools that are meant to improve on top of what we can get from your traditional third-party providers. And this is something that Gavin mentioned. So one area in climate specifically that I would highlight is the usage of NLP, or natural language processing techniques. We have one of my colleagues at AQR, Brian Kelly, wrote what I believe is the first academic paper that is literally titled Hedging Climate Change News, and trying to tap into NLP techniques and newswires, for example, to understand how exposed a given company might be to climate type risks. You can do a lot more than they did in the paper. On the low side, you probably have seen bar charts about how many times people mention climate change, for example, on earnings calls. That's a nice and easy way to use some fairly simple techniques to understand this. You can actually build a much richer understanding of language that people use in earnings calls, for example, or in brokerage reports or newswires and any number of other text data to actually improve on information that is more traditional, like, for example, greenhouse gas emissions. In my view, there is no silver bullet today, and I'm very skeptical that there would be a silver bullet at any time in the future. So, in my opinion, well-designed climate strategy will probably be more of a mosaic approach, where you will tap multiple different pieces of data, ideally looking at different sources. So you could look at the company reported items, for example. You can look at the maybe evaluations from third-party services. You can make up your own views based on, again, a variety of data that may or may not be reported by the company itself. You also need to be very clear about some of the trade-offs. And my last comment here, maybe I'll illustrate one of these trade-offs. One of the things that you may want to look at are, green technology or, green revenue, green patents. Very frequently, this will be actually conflicting with other metrics that you may reasonably look at. So you might find that some of the companies that are the biggest holders of green patents, or they have the highest quality green patents as measured, for example, by citations by other patents, happen to be oil majors, which shouldn't be surprising. These are companies that have deeper pockets than a startup fund may have, that have been working on this sometimes for decades. So you actually might have a clash between the emissions of these companies, fossil fuel reserves of these companies, but at the same time, if you wanted to build exposure to green technology, you might need to sort of trade off the two between themselves. I'll pause here, but this is a very rich topic worth a much longer conversation that we have time for.
And Ryan, if I can just briefly add into that, I think, climate change, bizarrely, is maybe one of the easier areas of ESG from a quantum and a measurement perspective, because we have a long history of, international standards for what a greenhouse gas emission equivalent is, how we apply that. We also have an international convention that shows us the target of where we need to get to and how many emissions, therefore, we need to reduce over what period of time. And we can plot that very clearly, and we can then run scenarios. We can then compare, within a sector between companies. We have our regulators around the world and central bankers all looking at, climate vulnerability assessments, climate scenarios. We have standard frameworks, the Task Force for Climate-Related Financial Disclosures, of course, being the main one. So it's one that you really can unpack from an accounting or a measurement perspective. And then obviously the complexity comes within sort of the scope 1, scope 2, scope 3 emissions and who is responsible for what level of those emissions. I think you'll see this shift of investors pushing the responsibility onto scope 3 emissions increasingly and the responsibility of those downstream emissions. But yeah, I think it's from a measurement perspective, it's one you can really get your teeth into. That trajectory is not going to be linear. I think that's the main thing. So also as an investor, or you are trying to guess what that pathway is going to look like, and it's going to be most likely pretty messy between now and 2050. But with the large signal coming from investors around these commitments to net zero emissions targets, which has become really a global phenomenon in the last 12 months, really, that has really set in train alongside government commitments. You've got investor commitments. Capital is going to flow to start heading in that direction towards that 2050 net zero target. Whether that's soon, whether that's slow, whether that's middle of the way, that's the job of investors to try to navigate that, and companies indeed to try to navigate it. But it's one area where you can really get your measurement and your accounting frameworks out and really start doing some good analysis around.
Great. Well, I think we have time for one more question here. So I'm going to throw this up to Andrew and Gavin. And really, the question is, we think about whether it be climate or we think about ESG, that we've got these kind of, first is like, is it an active or is it a passive strategy? But then also maybe you can touch on these kind of notions about how people and investors end up expressing their views across those different strategies. Some don't own them, some short the stock, and some own them and engage. Maybe if you have any ideas about what you think are the preferred kind of, or some of the best ways there.
Thanks, Ryan. I can only talk about, I guess, what we do here. We're a long-only equity investor, so we take the view that we own those assets, and we're stewards for our shareholders. They own the assets in our company, so it is a chain. So we definitely take the view that it is an active strategy. In our view, we talked about quality and how important that is for driving out performance, and how ESG is a crucial part of that quality. When I was in the dairy industry, I used to work with a farmer, and this is probably fairly common, who used to be at the milking sheds every morning and every evening, looking at each cow that came in and saying, is that cow working for me? Can I get a better return from a different cow? And if the cow wasn't working, it was off to the knackers, and another cow would be brought in to replace it. And that's how we look at with stocks. Is that stock working for me? Is this investment actually working for me? Is it doing what I want it to do now, in the medium term and in the long term? Can I see the potential for that stock to do what it needs to do? So absolutely, in terms of an active business, that's how we look at it. And so we are owners of stock. We believe we own the assets. I talked about the Rio experience earlier. If we're not happy with the way those assets are being managed, absolutely, we talk to the chairman, we talk to the board, we talk to the CEO. We say, we're not happy, things need to change, or can you give us more information on that? So it's active engagement with the people who are managing these assets that we own on our behalf. It was an interesting point, and as I said, going back to what both Lukasz and Simon had said in terms of simply not owning, yes, we will not own an asset if we don't believe that it's got fundamental long-term value. But I'll go back to or I will mention what Ivan Glassenberg, formerly of Glencore, said. He said, disposing of fossil fuel assets and making them become someone else's issue is not the solution, and it won't reduce absolute emissions. It's an interesting point of view. I understand what he's saying, but you don't necessarily want to be the last person holding that particular assets as it's going rapidly out of value. All of these things are what we need to consider. Thanks.
Gavin, turn it over to you.
Right, thanks, Ryan. So yeah, this active-passive debate is really important. And again, obviously, similar to Andrew, the importance of an active approach, and for several reasons. One is an active approach allows you to be so much more refined in terms of how you evaluate ESG. Passive approaches tend to take a much more one-size-fits-all approach. But with an active approach, you can get in and better identify those ESG issues that are important in, say, certain industries where there's clearer evidence that those issues are impacting company performance. But also about being more refined in the evaluation. You can do that more detailed analysis to better avoid these firms who are greenwashing themselves, or what we also call ESG traps, for instance. That requires an extra level of analysis beyond what you can get passively. But probably what's the most important part about the evaluation framework being done actively is that it's not static. It evolves through time. Think of how much our knowledge of ESG has improved in recent years through the trade wars, through COVID, the extra insights. An active approach can adapt and evolve through time. So an active approach is important, first off, from that evaluation perspective. It's importantly, secondly, in terms of how you can combine ESG with other investment insights. Passive approaches tend to be more just single factor smart beta products, if you like, using only ESG. An active approach incorporates other investment insights, like valuation, helps you ensure that you don't overpay for ESG, for instance. Very important because there's always talk of being in an ESG bubble at the moment. There's also importance from an active approach about how we better control risk in portfolios. Simple ESG passive strategies tend to just exclude, if you like. An active approach can better balance ESG against other risk drivers. And on this point, part of your comment at the beginning, question at the beginning, Ryan, is like, what's the best approach here? Is it outright excluding or is it tilting? This also comes down to investor preferences in their active risk budget. If they're willing to take on much more active risk and maybe wanting to ramp up the improvement in their ESG profile even more, then you can be more aggressive outright excluding companies. If people are more risk averse, wanting something with lower tracking error, then it's more about tilting away from the worst companies, tilting towards the more attractive companies. So that integration, that balancing with risk can vary by investor type. But two last points about the importance of active. One is an active approach allows you to engage, interact with companies and feed back the benefits and those insights from engagement back to your investment process. And then last, an active approach allows you to customize solutions for investors. I said at the very beginning, preferences vary so much across investors. In an active approach, you can take on those investor preferences and develop a much more customized solution for those investors. So an active approach is critical to develop and deliver more attractive ESG solutions.
Great. Well, the warning is flashing and our time is about up. But I just want to thank everybody on the panel. I think we covered a lot of ground, and well, it might seem like we just scratched the surface. Hopefully, we did try to touch on some big areas relatively quickly, and there's lots of good follow-ups. And I think we'll be available for additional questions in the comment bar. Thanks to everybody, and thanks to the conference organizers and the conference participants.